Hello there. Welcome to this uh, video lesson. Oh, there's the camera. I'd love to welcome you to this video lesson, and I'd love to thank you for watching and following me. Also, I'd love to thank my mentors, Robert Kiyosaki, who wrote the book Rich Dad Poor Dad, Matthew Crater, who wrote the book Rocket Stocks, and Timothy Sykes, who wrote the foreword to the book The Penny Stock Guide. And you can find all of these authors on Amazon Kindle. Now, today I have prepared a small lesson for you. And then afterwards, I'm going to talk about the rocket booster strategy, which you can see. And basically, the rocket booster strategy is a beginner uh, technical analysis for beginners. All right, so it's not advanced, it's for beginners, and I'm going to talk about it. But before I talk about the rocket booster strategy, which is the beginner level of technical analysis, I have a free, I have a lesson here that I have prepared for you. So the lesson is the 5 economic benefits of interest rate decision in banking. Okay, so let me just turn this off. Now let's get into the lesson. So, the 5 economic benefits of interest rate decision in banking. Now, interest rate decisions play a critical role in the functioning of the banking sector and the broader economy. So, because of that, here are 5 economic benefits associated with interest rate decisions in banking. So, number one here is monetary policy. So, remember, the interest rate decision is as a monetary policy tool. So, central banks such as the Federal Reserve in the United States or the European Central Bank use interest rate as a primary tool for implementing monetary policy because by adjusting the interest rate, central banks can influence the money supply, inflation, and economic growth. So, inflation is basically the cost of goods and services. This helps in maintaining price stability and promoting sustainable economic development. So, number two is inflation control. Because one of the primary objectives of central banks is to control inflation. Now, adjusting interest rates can impact consumer spending and business investment. So I want you to know, like I said, inflation is the price of goods and services in an economy. So they are doing this to control the prices of goods and services in the economy. Higher interest rates can discourage borrowing and spending, which may help to cool down an overheating economy and control inflation. Conversely, lower interest rates can stimulate economic activity during periods of low inflation or deflation. So, like I said, when you see the word inflation, remember, it's very much aligned to the economic activity, right? So the prices of the economic activities. Number three, on the benefits of interest rates. It is used for encouraging investing and borrowing. So lower interest rates make borrowing more attractive for businesses and individuals. Now, this encourages investment in capital projects, expansion, and consumption because This in turn stimulates economic growth and job creation. Conversely, higher interest rates may discourage borrowing and spending, which can be useful in preventing excessive borrowing and speculative bubbles. So, what happens is an interest rate basically is the cost of borrowed money. So the central banks are borrowing money to to other local banks within the private sector, as well as institutions such as insurance companies and insurance companies and corporations. All right, so let's see if we can let's see if I can find something here. So my bad. So basically, I'm trying to find a pad here. See if I can find the pad. All right. So basically, what you need to understand is that the bank. All right. Okay. What is happening here? All right. I'm trying to find a sketch pad. Okay. All right. This will do for now. Okay. All right. Now I want to draw this out for you. This is the first time I'm using this tool. So let's see what will happen here. Okay. Okay. All right. So basically, this is the bank. Okay. So this is the central bank. Okay. All right. We'll call that C bank. So these guys here control the interest rate, which is the cost of borrowing money. Now, the main institutions, though they are more, but right now I just want you to know these three main institutions. So there are three. Okay. So we have local banks here. Okay. All right. These are local banks. Okay. Boinks. All right. So we have the local banks, then we have insurance houses. Okay. We'll just put IH for an insurance house, and then a corporation house. Okay. So these can be like big businesses. So these guys, these central banks borrow money to these institutions. All right, and this kind of leads me up to kind of what happened in the financial crisis of 2020 and was it 2020? I think it was 2020 and 2008. It was here where the crisis was. It was with the local banks. So these guys were borrowing money from the central bank and then giving home loans to people that could not pay back. Then in 2020, it was it was the corporate houses. That's where the financial crisis was. I think AIG was also an insurance company. I think 2020 or 20. I think 2008 it was too. I think that's why it is still the biggest crash today. And then in 2020, it was the corporate houses like companies in Silicon Valley, but also as well, one of the companies was also a local bank, a crypto bank. So basically, if these institutions get too much money and fail to pay back, if they make bad investments, that's what causes financial instability. If these institutions fail, you know, oh, there's there's a text pad here. Anyway, so basically, if these institutions fail to pay back to the central bank, so imagine, let's say they borrowed at 3%, right? And then on their balance sheets, it is negative 9%, right? That meaning they're not making profit, or the companies that they borrowed to are not able to pay back. And then all of a sudden, this interest rate now goes up to -5. Okay, so what does that mean? This -5 is transferred to this 9% here, and then instead of it becoming -9 percent, the costs now increase to -14, and this is what eats up into the business operations. So some examples of business operations could be paying their employees, buying electricity, but basically their expenses go up, and this is what causes bankruptcy. So whenever the Federal Reserve increases interest rates, it increases the costs for these banks, operation costs. And then if they do not manage their operation costs, or they have not adjusted their operation costs to the rise of interest rates, that's what causes the banking failure. So I don't know how much time I have. Okay, I think we have like 5 more minutes of recording time. So I just wanted to explain that. And okay, just excuse me for a moment. Okay, I had to pause a little bit there. I had an incoming telephone call. Now, again, so back to the lesson. Remember, number three, the main point of interest rates is to encourage investing and borrowing. So, lower interest rates make borrowing more attractive for businesses. So, remember this chart here, right? Because this also represents businesses who are borrowing from the central bank. So basically, it does attract, makes borrowing more attractive for businesses and individuals. Now, this encourages investment in capital projects, expansion, and consumption, because this in turn stimulates economic growth and job creation. Conversely, higher interest rates may discourage borrowing and spending, which can be useful in preventing excessive borrowing and speculative bubbles. Now, number four, benefit of interest rates is stabilizing financial markets. Now, interest rate decisions can have a significant impact on financial markets. By adjusting interest rates, central banks aim to stabilize financial markets and prevent excessive volatility. For example, during times of economic uncertainty or financial crisis, central banks may lower interest rates to provide liquidity and stabilize. Okay, I'm just checking the time. Okay, we're left with about 4 more minutes. All right. So, central banks may lower interest rates to provide liquidity and stabilize financial institutions. And then finally, exchange rate impact. So, because interest rates can influence exchange rates, and changes in exchange rates can have implications for international trade and investments. Now, high interest rates may attract foreign capital, leading to an appreciation of the currency. Conversely, lower interest rates may lead to a depreciation of the currency, potentially boosting exports. And central banks consider these effects when making interest rate decisions to maintain a balance in exterior sector. So always remember, it's important to note that the impact of interest rate decisions can vary depending on the overall economic conditions, including the stage of the economic cycle, inflationary pressures, and global economic factors. Additionally, the effectiveness of interest rates policies may have limitations, and central banks often need to consider a combination of monetary and fiscal measures to achieve their economic objectives. So now I'm going to share with you the rocket booster strategy. So the rocket booster strategy is broken down in three steps. So step number one, the price represented by these candlestick bars here has to be above the 50-day moving average represented the that's number one. Number two, the price has the 50-day moving average represented by this blue line here has to be above the 200-day moving average represented by this red line here. Then number three, the 50-day moving average should cross the 200-day moving average. And when it does so, it gives you a trend analysis indicator of buy. So that's the rocket booster strategy. And we can see that if we look at the breaking news here, the Bank of E has an interest rate decision on 1st of February this week, and they are forecasting at 5.25%. So you can see that what we were talking about in the education is actually related to what is happening in the forex trading market. My name's Lubosi Forex. I would love to thank you so much for watching uh, this video. Please feel free to rocket boost this video and watch it again. I'd love to thank you for watching as well. And my disclaimer is, do not buy what I tell you to buy. Do not sell what I tell you to sell. Do your own research before you buy and sell anything. So trade safely out there. Take care and bye bye.